I target kind of falling off a log silver price $100 an ounce. The old high of 50 that Hunt Brothers established in 2011 echoed. We're going to go through that. I mean, how is it that this is an absolutely necessary, essential commodity that everyone needs and uses, and yet we're not at an all-time high when literally every other commodity in the world has put in all-time highs? I mean, it's stunning to me that they've been able to suppress it so much, but they have, and this, I mean, as you point out, the system is not fair and there's a lot of rigging going on. Gold, I think in the last 12 months is up over 50 or 60%, which it very, very rarely does. And as you've pointed out, the divergence between real interest rates and the price of the metal, it's been stunning since 2022. And of course, what triggered that was when we grabbed the
The precious metals market is undergoing a profound transformation that has caught the attention of seasoned investors, such as Lawrence Lepard, a prominent advocate for hard assets over fiat currency. Lawrence Lepard's silver analysis centers on decades of artificial price suppression. Using the metaphor of a beach ball held underwater, Lepard argues that silver's actual value has been systematically constrained but will eventually break free with explosive force. His $100 per ounce prediction reflects his belief that the metal's industrial utility and monetary properties have been grossly undervalued. Lepard's $100 silver target rests on three factors: persistent supply deficits creating structural imbalances, rising industrial demand pressuring available inventory, and silver's deep undervaluation relative to gold. Achieving this target requires approximately a 175% increase from current levels, one of the most significant gaps between present value and future expectations in commodities. Lepard highlights gold's 50 to 60% surge over the past year as a rare and unexpected move, marked by a sharp divergence from real interest rates since 2022, breaking the long-held inverse relationship that traditionally guided precious metals pricing. Gold's momentum has surged in 2025, driven largely by President Trump's tariff policies. Forecasts now estimate an average price of $3,675 per ounce by late 2025, supported by strong central bank and investor demand, averaging 710 tons each quarter. The breakdown of gold's traditional relationship with real interest rates signals a fundamental shift in the valuation of precious metals. Gold's price discovery mechanism now incorporates geopolitical tensions, concerns about currency debasement, and central bank diversification away from dollar-denominated assets, rather than relying solely on simple interest rate differentials. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Only 2.6% of viewers have subscribed, so join them today. Your support is greatly appreciated.
Gold, I think in the last 12 months is up over 50 or 60%, which it very, very rarely does. And as you've pointed out, the divergence between real interest rates and the price of the metal, it's been stunning since 2022. And of course, what triggered that was when we grabbed the Russian reserves.
Yeah.
So my operating thesis, Chris, and I talk about it in the book, and I think you and I have discussed it before, is that we are in a sovereign debt crisis. And the evidence of that is that gold is at record price highs. Bitcoin is at record price highs. The only piece of it still missing in the puzzle is silver still not, although I think because what's going on, as you pointed out earlier, more and more people are waking up to the fact that they can't stop printing. They will have to stop printing. These bonds, you'll be paid back in nominal terms for sure. They'll give you the money. The problem is that the money won't buy as much. And it's quite straightforward. And so, what it suggests to investors, as I say in my book, and I know I have a lot of friends who are boomers who've done extremely well, and they have big stock portfolio's, and some have bond portfolios too, although they're moving away from those. And I say to them, I say, guys, if you don't have some sound money assets, you're going to get, this is going to be rough for you, because this decade, in my view, is going to look kind of like the decade of the 70s, perhaps even worse. And in the 70s, stocks went nowhere, and gold and oil, performed extraordinarily well because there were things that could, there's a lot of paper silver out there, as we know, and there is a fair amount of junk silver. I mean, my coin store, I go there regularly because I'm always buying coins and stuff, and he's got more tea sets sitting around, and it's sad too, because what you find is an elderly couple, and they're running out of money, but they have a beautiful tea service that they were given at their wedding or something like that, and he's happy to buy it for the melt value or some fraction of the melt value, and so there is silver that comes back in, but in general, you're right, most silver gets used, and it's hand to mouth, and there are all kinds of new technologies that are developing need more silver. I mean, and cars need more silver, batteries need more silver, solar needs more silver. In fact, this new Toshiba solid state battery that they think might really revolutionize car performance.
Very exciting.
Yeah, that needs a ton of silver. So you can hold a beach ball underwater for a while, and in this case, they've obviously done it for several years, but it's going to break free. And my target, kind of falling off a log silver price, $100 an ounce. The old high of 50 that the Hunt brothers established in 2011 echoed. We're going to go through that. I mean, how is it that this is an absolutely necessary, essential commodity that everyone needs and uses, and yet we're not at an all-time high when literally every other commodity in the world has put in all-time highs? I mean, it's stunning to me that they've been able to suppress it so much, but they have. And this, I mean, as you point out, the system is not fair, and there's a lot of rigging going on. Keep in mind, though, that it's really the dollar against other fiat currencies. So these are all paper currencies, and they're all destined to fail. Two of them are, the yen and the euro are the two biggest ones. And so, it's a problem that right now we're weaker than them, and that someday the yuan will be in there as a bigger currency as well. So, my view is it's, the dollar is important, but it's going to fade against these other currencies, and but they're going to fade too. And so the real cross that I'm always looking at is kind of dollar gold and dollar Bitcoin and dollar silver. It's just. There will come a time, in my view, when the dollar will not be a relevant currency. It'll be a much smaller piece of all transactions, and there'll be, multi-currencies. I mean, what we need is a neutral reserve asset, and gold fills that role.
Larry Lepard views this monetary evolution as highly bullish for unprintable assets, gold and silver that cannot be created through central bank policy. He contrasts this with real estate, citing ongoing tax obligations and lack of portability as key disadvantages. This distinction becomes crucial as monetary authorities expand the money supply, potentially devaluing assets tied to a specific jurisdiction. Analysts remain extremely bullish on gold as it reestablishes itself as an essential monetary asset globally. According to official sector sentiment, this trend, beginning in mid-2022, shows no signs of reversal. The shift represents a fundamental recognition that gold hedges against currency debasement and geopolitical uncertainty, surpassing the capabilities of traditional financial instruments. Lepard's forward-looking analysis suggests markets react early to monetary and fiscal policy signals, triggering increased borrowing and rising asset prices. This anticipatory behavior creates momentum, driving precious metals prices beyond their fundamental values as investors position themselves ahead of policy changes. The self-reinforcing dynamic accelerates trends once precious metals gain momentum. Market sentiment often favors stocks during economic growth and liquidity-driven rallies, causing investors to overlook precious metals. However, during periods of uncertainty, capital tends to shift towards safe havens, such as gold. Uniquely, in this cycle, gold continues to show strength even in risk-on environments, highlighting its growing appeal beyond traditional crisis periods. Let's get back to the interview.
The other thing I think is going on, Bissett and Trump have been talking about the possibility of having a shadow Fed president, appointing the next Fed president because they can't get Powell to resign. And of course, what that person would then say is, hey, just hang on until next May, and, we'll have ZIRP and QE and everything else. And of course, markets are nothing if not forward looking. And so, these markets will say, okay, great. All we got to do is hang on for, 10 months and it's party on, Garth. Well, we can do that. Let's borrow and lever up to do it, because we know that everything's going to go a lot higher when all that new money comes into the system in that time frame. So a lot of things going on, but that's kind of my take. And I think, what this implies to me, it's just incredibly bullish for the prices of things that can't be printed. And, the top of that list are Bitcoin, gold, and silver. And then a little further down is real estate. But real estate, I've always said, has a lot of problems because of the taxes and hard to move it and all that kind of stuff. So as one point you made earlier, you said, well, the Fed is tightening. Well, yes and no. They're still tightening on the mortgage bond side, but as you'll recall, a few months ago, the $25 billion per month of QT went down to $5. Tightening as much. And they're now talking. I mean, you see cracks in the system, right? I mean, there's this thing called the supplementary leverage ratio, the SLR. It determines how much a bank can buy Treasury bonds. Well, they're amending that to let the banks buy more of the Treasury bonds. I mean, they've got a problem. They've got $9 trillion of short-term debt that they've got to roll over, and with rates in the 4% range, that's a lot of money. I mean, the interest costs in this government debt we have today is larger than the defense budget, and I think it's getting close to being larger than Social Security. It might already already be a touch larger. So, they really need lower interest rates to try and get the budget even close to being, balanced or out of the billionaires. The people at the top who understand inflation and understand the way the monetary system is constructed, they have set this thing up in a fashion where the more inflation they have, the more we grow this machine, the richer they'll get. And it's at the expense of everybody else. And that's all because we don't have sound money, Chris, as you know. We don't have a monetary unit that doesn't inflate. When you have a monetary unit that inflates like crazy, and you have, favored players, Wall Street, hedge funds, people who can borrow at low interest rates, and then you and I have to borrow at 25% on our credit cards, we're at a massive disadvantage. And that's not what the Constitution of this country was set up to be. It was meant to be, they knew the outcomes wouldn't necessarily be fair because everyone has different sets of talents, but they wanted the system to be fair. And this system is grossly unfair, just grossly. It's tragically unfair, and it's causing so many people in this country to suffer. And therefore, we've got to change. We've got to break this system, rip apart the system, create a new sound money system. And that's why I wrote the book. I want, and I tried to write it in a way that average people would get it, because it's kind of a sophisticated fraud, and they make you feel like, oh, you're not rich. Well, you're just not working hard enough. Well, no, that's not really the case. The game's stacked against you, average guy. And
gold and silver continue to defy conventional market dynamics, with gold reaching record highs despite rising real interest rates, and silver poised to follow as a deepening 140 million ounce deficit meets surging industrial demand. With strong fundamentals and persistent supply constraints, silver is likely to see further upward pressure, potentially pushing prices to new highs. Both metals underscore a broader shift away from fiat reliance, signaling growing investor confidence in tangible, enduring stores of value. Can silver's recent breakout signal a more substantial upside ahead compared to gold as market pressures build? Let us know your thoughts in the comments. If you enjoyed this video, tap like, share it with others, and subscribe. Only 2.6% of viewers have. So hit that button and turn on the bell to stay updated on the latest in gold and silver.